Now to Will Rhode, Director of Capital Markets Research at Boston Consulting Group. So please give a big hand for Will and his speech. Thank you. Good luck, sir.
Thank you, Carl. Thank you very much, Carl. Good morning, everyone. Very pleased to see so many of you here today. And terrific work by WBR for putting this together. I remember when we first had a conversation about it in a pub, talked about it, drew it out on the back of a napkin, and now it's a real thing, and we're all here. So many thanks to everyone at WBR for fantastic efforts. So I'm going to talk a little bit about regulation. Some of the nuance of clearing in Europe versus the US. Trading 1 and 2. So I think we've been talking a lot about the front office, but I think what this places in an electronic environment, more focus on the back office. So think of that as 2. Product selection, we had a lot of conversation in the US around alternative products. Is it true, is it not? And my 2 cents on that. And then something I've called the fragmentation paradox. We talked a lot yesterday about fragmentation or concentration. And I think that's really the paradox. When you have multiple choice, the market tends to migrate to what it knows, and it chooses 1 or 2, and there are reasons for this. There are economic reasons for that. So when Oliver and I were talking a little bit about how we should look at the regulatory landscape, he said it would be quite nice to look at the past, the present, the future, and in a way Dodd-Frank is yesterday's news. Today we're dealing with cross-border issues, the introduction of EMIR, and then we're looking towards 2017 for MiFID. And then what I ended up doing was saying, well, why don't I just write down the hot button topics for each of these segments, and it ended up into this quite long laundry list. But I'm going to take a couple of minutes to try and get through it. If we recall, we had registration in the US. It's a difference for the US, and it caused a lot of firms to say, do I want to do business in the US? Then we had the reporting mandate. We had multiple swaps data repositories. There was competition. There were lawsuits. We had legal entity identifier programs. And what this raised to the industry is the prospect of mutualization of costs, which has become a more current topic today. You're seeing more firms talking about what can I turn into a utility. We've had clearing. Multiple derivatives clearing organizations. How do I introduce efficiency there, collateral optimization, the introduction of compression, compaction for the buy side to reduce operational risk, margin efficiency, new products that come into the clearing landscape, such as swaptions. So the CME, I think, has announced it's going to clear. Then we've had CEFs. We had the made available for trade rule. We've had product alternatives like swap futures. We've had the traditional debate between whether the CFTC and the SEC should have merged, who looked after single name CDS versus everything else. And then we've had a changing of the guard at the CFTC, and we don't have Chairman Gensler anymore, nor any of the original architects. So right there, you can already remember, like some nostalgic journey, a huge array of hot-button topics, just in the US. What are we talking about today? For cross-border, we saw CEF avoidance. We saw some interdealer brokers literally just get out of the United States to help their clients not have to deal with any of the Dodd-Frank rules. We had this whole idea that pools of liquidity would fragment. So ISDA's done a lot of work about how the interdealer broker market for euro interest rate swaps is really migrating here into the European landscape. And this, of course, is regionalizing the market. But the nuance of this is actually you're now starting to see localized liquidity emerge. Yesterday, there was some conversation around the Project Neptune, which is really a local initiative to try and discover liquidity in the United Kingdom. And obviously, when BlackRock announced their Aladdin trading network, that was a US focus. So when people talked about global risk books or global trading operations, the reality was that the US desk and the European desk probably very rarely actually coordinated or spoke to each other. So we think about a global risk transfer process. We think about these businesses in global terms. Regulation has regionalized them, and now liquidity is localizing. Cross-border margining, the mass transit utility, these are, again, initiatives to try and help firms, even though we've got different clearing jurisdictions. We can try to find in the global custodian network, how can I get collateral from one place to the other to cover my margin call. We've got the non-cleared margin rules coming out, extremely punitive. Volcker, Liquidity, Basel, all very impactful pieces of regulation on the traditional intermediary model. We've had CFTC scope creep into Europe. How does ESMA tackle that? Recognition of overseas CEFs. Then we got EMIR. We've dealt with buy-side reporting. Thankfully, brokers have helped firms deal with that. We've obviously now got clearing recognition, cross-border CCP recognition. There are different clearing standards in Europe, and I'm going to talk a little bit about that. And it's a horizontal landscape, and you can have individually segregated accounts here. Going forward, MiFID, it covers equities, and it covers FIC, so it covers everything. We've got uniform application, so not MiFID, not a directive, but a regulation, MiFIR, because not everyone actually implemented MiFID. MiFID 1, that is. We've got limitations on broker crossing networks. We've got limitations on HFT. We've got research unbundling. That's the first. And we've even got the possibility of individual segregated accounts for equities, because somebody told me that actually EMIR doesn't not say equities. So what does that mean for settlement process? FIC, we've got the pre-trade transparency liquidity determinations, and we've got the post-trade liquidity determinations. And I think there's been a lot of focus on how those should be calibrated. And then the buy side has additional pressures in terms of disclosure rules, commissions that are being charged, conflicts of interest. So right there, a laundry list, just to think about what are just the hot button topics, and I haven't even really talked about them in any detail. And it took me 5 minutes just to get through that. So clearing in Europe is different to the US. There is a new standard for individually segregated accounts. It's expensive, but if you want, you can ask your broker to set up your own clearing account, and you will have no commingling of your margin with another firm. In the US, the new clearing standard that was introduced was LSOC, legally segregated, operationally commingled, which basically separated the house account, the buffer that the broker has, from the client account, which was traditionally put into a single omnibus pool. The difference with the individually segregated account is, first of all, that it is a difference in standard, and it can create additional costs for the buy side, and it obviously is an additional headache and another layer. But Europe has differentiated itself from the US in this respect. Down the bottom here, I've taken a sort of an average of some of the fee schedule that's associated with clearing. And obviously what this really results in is it's a lot more expensive to do the business that we were traditionally doing. So that can range from anywhere between $60,000 and $120,000 for an annual fee to your clearing agent, between $1.5 and $7.5 for a future. If you're paying by ticket, $500 to $750 for a trade. Or if you're doing it on margin, it can be 50 to 75 basis points of the margin that you're depositing in the clearinghouse. And then the exchanges have their own fees too, which can range anywhere between $0 and $6,000. New frictional cost, and depending on how the industry chooses to approach what they want to do with clearing and how this will treat margin, there will be a difference in costs that's chosen. So trading 1 and 2. One of the things I think that's kind of interesting is that even though here in Europe they talk about the introduction of MiFID and what that means for pre-trade transparency or regulated trading, particularly of corporate bonds and everything else, they're having the same debate in the US. It's a global debate, and really it comes down to this whole notion that technology is being introduced into a world that traditionally trades by voice. The notion here, of course, is that everything's going to go in a linear progression up this S-curve and reach the holy grail of the futures and the equities market. I don't think that's actually true. I think there's probably multiple paths to that destiny. But intuitively, we understand that a lot of these things are somehow going to migrate through this process. And one of the ways in which they're going to do it is this evolution of principal and riskless principal matching and the introduction of the agency model. And we've had a bit of a conversation around what does this agency model in fixed income actually look like? How does it work for spread-based products compared to other instruments where you can charge an explicit fee? But the point being is, regardless of anything that you're thinking about in regulatory terms, is the broader acknowledgement that the world is becoming more electronic. So if we were in a linear world and we'd say, well, great, I'll just go to the equities roadmap and it will tell me all the answers and it's a playbook and we won't have to have a conference about it because we already know how it works. But there are differences between fixed income and equities, fundamental structural differences that people can't actually figure out why one applies to another. In particular, in the top left-hand corner, we can see what's happened in the equity markets in terms of ticket size shrinkage, the introduction of decimalization, and huge volume surges. So is that the good news story that we can expect to emerge in the world of fixed income? Well, corporate bond ticket sizes have been going down. According to Trace, the average ticket size may be $700,000 down to wherever it is, $400,000 today. Now, the reality, of course, is a lot of trading gets done in the $25, $50 million range, not the $700,000 range. But it's nothing like what we've seen in equities. And that's because even though the corporate bond market might be in total value, this is US, 7 trillion compared to 24 trillion, there are 52,000 bonds compared to 5,000 stocks. And we know about that. So there's a lot of names, so how do you find liquidity? And out of those, only a few bonds, a tiny percentage, this little blip down here, trades every day of the year. So a bond that trades once a day is obviously very liquid, whereas a stock that trades once a day is not very liquid. And what the electronic trend really means is this changing of the value chain, right? There are now multiple entry points into how you're going to execute a transaction. You can go to your bank, they may quote you off of their single dealer platform, and you might trade with that bank. Alternatively, they may agency your trade into a broader market. This is an FX illustration. And then you might end up back at your broker, your bank, because he actually did have the best price in the first place. Alternatively, the whole market may navigate down to an anonymous multi-dealer platform. You may end up into a prime broker as your counterparty, who, through a full circular, may even end up meaning you still come full circle back to the original bank that you asked to execute the order on your behalf. Or you go direct to the ECN, the multilateral platform, you follow that food chain at the top, or you're RFQing to a specific set of names that you want to actually transact with. But the point being here is it's competition for desktop real estate and the opportunity to transact with different firms. It's a changing of the value chain. It's not pick up a phone to one firm now. So here's trading two. BCG majority owns a firm called Expand. And Expand's been collecting data from banks for about 10 years on IT and operations spend for benchmarking purposes. But they also have a client intelligence service. So they go to market and ask some interesting questions. Operational efficiency is the #1 criteria by importance for an e-business that clients are actually looking for. And what does that translate into? Successful error resolution, effectiveness of settlement, responding to issues, no STP fails. So the emphasis is shifting in an electronic environment, even though we're thinking about it in front office terms, to a greater importance on back office servicing. And so I think you can expect to see that become more and more important as you start to think about why this business is changing. Product selection. A lot of conversation in the United States about swap futures alternatives. They're cheaper, so why wouldn't I use them? Are they an exact match? Well, first of all, we've talked a little bit about electronic. Generally speaking, 2/3 of the market is still trading by voice. But would you choose a swap futures alternative contract? Most folks are saying no, probably not. It hasn't really taken off in the same way that people had anticipated. There's been a lot of listings, there's been a lot of anticipation, and it's because they're not convinced, A, about what electronic means for the business. They may see good liquidity in listed derivatives, but it's hard to see it developing as a proxy. Because guess what? There was a reason why the swaps market developed, and that's because it was an exact match. But the ETF market is a very interesting new asset class that is emerging and is relatively under-recognized, or it has room to grow in fixed income. So now, these are global numbers, but the size of the equities market, 61 trillion in total, 85 trillion in fixed income. Passive AUM as a market, $6 trillion in equities, $2 trillion in bonds, and the global ETF market for equities is $2 trillion and only 0.35 for fixed income. I think fixed income ETFs are going to grow a lot. And I think that this may be the new product alternative debate away from swap futures as fixed income becomes more equity-like. And then, of course, there are other listed derivatives that can be licensed off of those products. So to the fragmentation paradox theory, right? Bank revenues are flattening, and they have been for 2 or 3 years. And we expect them to be pretty flat going forward. So what this really brings us to is this idea of a kind of transversal theory, right? And in the corner there, you can see financial technology providers, financial information service providers, third parties, that can start to make explicit a lot of the services that have been given away by banks as a soft service in return for trading business. Because banks are selling those assets because guess what? Their revenues are flat. So you have alternative providers now coming into the marketplace, and this creates a different value proposition for those firms to effectively become CEFs, OTFs. What is the role of information in that food chain? And so if we want to understand why concentration occurs in a fragmented landscape, it's because of scale. So in the FX market, 3 or 4 banks dominate that space because they invested in the internalizer engines, invested heavily in those internalizers, and built the scale for a business that allows them to pick up both sides of the spread, not one side of the trade where they're competing. It's very balance sheet light, which is very important as balance sheet becomes more expensive, and it creates asset velocity, which is a key lever for improving return on equity. And everybody else struggles. So if you recall the electronic S-curve, the question that a lot of intermediaries ask themselves is, where am I going to pick my spots? Which market do I want to be number 4 in, 1 of 4? Because I'll own that, and I'll give the rest away. So this is some of the ways in which we're thinking about how firms are strategically positioning themselves for this electronic wave that's coming through the market, how they're building their businesses, and why you as a community are going to see firms invest heavily, perhaps in some spaces, and be less invested in others, and it's going to make you think about the changing value chain, what is the nature of your relationships, and why are you picking those firms? Any questions? Please do.
So you talked about the US portion and the UK portion, or the European portion, I suspect. Mm-hmm. Can you just tease out a bit more about what you see as the main differences, particularly in the corporate bond world, between the US and Europe? I'm sort of interested in that space.
Well, I think, thank you, Carl. Yeah, I think, well, the key difference is it's not regulated for mandatory trading, right? But nevertheless, there's a lot of conversation still occurring in the United States about how bonds could trade electronically and you know, what would we need to see in order for different venue alternatives. And it really comes down to this liquidity issue and this migration of liquidity onto buy-side portfolios. And this is the big challenge. And this has a dual challenge. First of all, the buy side doesn't necessarily have an infrastructure in the same way that the sell side has an infrastructure to transfer risk. So a lot of the conversation that we've been having today, or yesterday rather, was around the establishment of networks, right? And how would they potentially trade with each other? And how would that relationship actually look like? So as dealers back away from the market and are not providing balance sheet to the client in order to service this risk transfer process, the buy side wants to know how it can trade with each other so it can actually do more bonds, trade more of those illiquid bonds than they were trading. The backdrop to that is this fear around QE and a possible dislocation in the fixed income market, and what will happen to NAVs in the event of an interest rate increase or increased volatility in the market. So I think that, again, it doesn't need regulation to change a lot of the things that we're already talking about here in Europe, and so it's not just a European, it's not driven by regs. Anybody else? So the gentleman, oh, sorry. 1 minute.
Morning, Will.
Morning, David.
You talked about ETFs and swap futures in the same kind of slide or breadth.
Yeah, as a product alternative, yeah.
Yeah, can you just elaborate on that? Because I don't. A couple of us here were thinking that's not
the equification, if you will, the exchange traded. So for swaps and for swap futures, swaps are an OTC product. Swap futures are a listed product. So it's the exchange opportunity in this product set. So for ETFs, the fixed income ETF connection is, well, here's another exchange avenue to a market that's traditionally OTC. So that was my point. Okay, makes sense? Yeah. Okay, super. There's a gentleman over here. I don't think your microphone's on, Renaud. Okay.
Is it better?
Yeah, that's great.
Hi, Will. Just wanted to make a couple of observations on some of your slides.
Sure.
The first one, the clearing side. I think that it's true that the price of clearing and the price of clearing from the sell side comes at a price, unfortunately. Mm-hmm. Mm-hmm. But maybe the message which should be conveyed is the reason why it's been implemented is to avoid a potential Lehman or potential future Lehman.
Yep.
And maybe stress on the fact that if going forward one of the dealers were to default, the clearing mandate will allow the buy side to port their position and their collaterals without them being liquidated.
True.
So I think that's an important message to convey.
That's true.
The second point regarding swap futures,
Mm-hmm.
though it's true that in the States they have not so far taken off, the interesting element to take into consideration is that the local exchanges in the dialogue with the CFTC have seen that for the margin requirement, the CFTC was more than happy to have a 5% initial margin compared with normally a 10%.
Mm-hmm.
So which means that, going forward, it is most likely then, when swap futures become business as usual,
Mm-hmm.
That will be an incentive for people to use those products as well and along their IRS swaps cleared.
Totally fair observations. We are in early stages, and it does take time to develop liquidity in exchange-listed products. We know this. That is true. I think a lot of firms and a lot of individuals may say, well, where are the immediate results? If this is such a no-brainer, then why isn't it happening today? But I take your point. We're still there, and you guys particularly are also innovating in this space. But to your issue of cascading counterparty credit risk, there have been enough conferences I've attended that have argued the exact opposite, that clearing actually introduces risk concentration. Yes, clearinghouses do have waterfall mechanisms, that it is recognized, and I don't think there's any point to have that particular debate. But the issue here is, what I think is interesting is that clearinghouses are offering a systemic buffer to the system, but they're also competitively trying to create value propositions where they can introduce efficiency. So collateral optimization is one. The expansion of the products that they do clear is another. So swaptions to become a cleared product is an important part of that product expansion. But we've never seen swaptions be cleared before. So there are unknowns, in fairness. So just as we don't know the future of swap futures, we also don't know what the effect of clearing other products is. Any other questions? Very good. Well, if there are no more.
Will, thank you very much. I think that was a very interesting conversation.